right now, you likely have this this six-figure employee living inside your walls, and they were completely asleep on the job.
Yeah, just totally asleep.
Right. Because, I mean, we tend to view our homes as these rigid physical containers for our everyday lives. You think about the bricks, the mortar, the property line.
Sure.
But beneath that physical foundation is this invisible, constantly humming financial engine.
The problem, though, is that most people let that engine run in the dark, like without ever checking the dashboard.
Yeah.
They treat their primary residence as a completely passive object. So our deep dive today is based on an insightful guide titled 3 Strategic Ways to Use Your Home Equity in Today's Real Estate Market.
Which is a great read, by the way.
It really is. And the objective here is to completely shift your perspective on what a house actually is. We are, moving away from looking at a home purely as shelter and exploring how to analyze it as a highly adaptable strategic financial instrument.
Okay, let's unpack this. Because for an audience that understands the basic mechanics of real estate, we don't need to waste time defining equity, right? We all know it's the gap between what your property is worth and what you owe on your loan.
Exactly. The basics are pretty straightforward.
Right. So we need to look at how that equity actually behaves. As your mortgage amortizes and your property appreciates, the volume of trapped cash inside your walls grows.
It just sits there.
Yeah, it sits there. But as that equity pool gets larger, your return on equity, or ROE, actually plummets.
Oh, this is such a crucial point.
I mean, think about it. If you have, say, $50,000 of equity in a property and it goes up in value by $20,000, your return on that trapped cash is fantastic.
Really strong.
But if you have $500,000 of equity in that exact same house and it appreciates by that same $20,000, your money is essentially stagnating.
Yeah, the math really shifts on you. And the foundational premise of the source text is that, well, building equity isn't really a question of if. It's inevitable if you hold a property long enough.
Right.
The whole strategy is entirely about what you actively choose to do with that growing pool of capital when you have it.
So it's about deployment.
Exactly. And the source breaks this down into 3 distinct paths. The first is the default path most people take, honestly, without realizing they're making a decision at all, which is leave it.
The long-term appreciation play.
Right.
You basically just live in the house and let macroeconomic forces do all the heavy lifting.
Yeah.
And historically, I mean, real estate is a robust wealth builder, particularly in markets with high demand and, constrained supply.
Oh, absolutely.
You let inflation and market scarcity drive the asset value up over decades. It's kind of like burying a coffee can of cash in the backyard.
That's a good way to put it.
It's safe, and it's growing slowly.
Yeah.
But I guess my question is, so what does this all mean for the listener's overall financial health?
Well, what's fascinating here is the hidden caveat in the source text. Most people view leaving their equity untouched as this neutral state, like a lack of action.
Just doing nothing.
Right. But financially, doing nothing is actually an active, aggressive choice. Think of that trapped equity as, like you said, an unpaid employee sitting in your break room.
Yeah.
By leaving the equity in the house, you are making a conscious decision every single day to keep a massive portion of your net worth tied to one single asset.
In one specific location.
Exactly. It's not necessarily wrong, but it demands awareness. You are earning a diminishing rate of return.
I see the math on the diminishing return on equity, for sure.
Huh?
But behaviorally, I mean, isn't leaving the equity untouched the safest possible play?
Well,
Because having a paid-off house or a heavily equitized house, that's the ultimate financial goal for a lot of people. It provides this immense psychological security.
it does.
Like if the market tanks, you still have a roof over your head that nobody can take from you.
Yeah, but psychological security and financial optimization are often at odds.
Okay, fair.
The text totally acknowledges the peace of mind a paid-off home provides, but it demands that you recognize the hyperlocal risk you are taking on.
Hyperlocal.
Right about it. If 80% of your total wealth is locked inside the drywall of your primary residence, your entire financial health is basically at the mercy of your town's zoning board.
Oh, wow.
Or local property tax hikes, or regional employment trends. If a major employer just ups and leaves your city, or the neighborhood demographics shift, your net worth plummets and your capital is trapped.
You're just...
You're entirely undiversified.
Yeah, you are heavily concentrated, basically betting the farm on the farm.
That's exactly it. And that concentration risk is why Leave It requires active awareness. You are choosing to forego the returns that capital could be generating in, say, the stock market or in commercial real estate or a private business.
all in exchange for the perceived safety of bricks and mortar. But look, there has to be a middle ground, right? For people who realize their portfolio is dangerously unbalanced, but they have no desire to pack up their family and move.
Oh, definitely.
Like you want to reallocate the capital, but you want to stay in the shelter. And the source calls this second strategy access it.
Yes.
You put the equity to work without liquidating the underlying asset.
You're unlocking that trapped capital through debt instruments.
So let's get into the mechanics of those instruments. Because the two primary tools the text mentions operate very differently. You've got a home equity line of credit, or a HELOC, and a cash-out refinance.
Two very different beasts.
Yeah. A key HELOC acts like this massive revolving credit card secured by your roof. You only pay interest on what you draw.
Right.
But the danger is that the interest rate is usually variable. It's tied to the prime rate.
Which can be scary.
Very. If macroeconomic policies shift and rates spike, the carrying cost of that HELOC can double in a year.
It can. And that's where a cash-out refinance comes in. It avoids the variable rate risk by giving you a fixed rate.
But there's a catch.
A big catch. It requires you to tear up your original mortgage note and replace it with a new one.
Which is brutal right now.
Exactly. If you secured like a 3% mortgage rate a few years ago, doing a cash-out refinance today at 7% means you are destroying one of your greatest financial assets.
That incredibly cheap debt.
Right, just to access your equity.
So you are accessing the capital to fund other ventures. The source lists things like buying additional real estate, renovating, consolidating high-interest debt, or funding a business venture.
Right, unlocking doors.
But wait a minute, I have to play devil's advocate here. Isn't taking on more debt against the roof over your head a really risky move? I mean, you're telling people to borrow against their primary shelter in potentially volatile interest rate environments to buy investment properties.
I know how it sounds.
Isn't this exact over-leveraging how millions of people lost everything in the 2008 subprime mortgage crisis?
Well, the 2008 crisis was largely driven by speculative consumption and artificial valuations, not strategic value creation. But your concern is completely valid, and the source actually draws a hard line on this specific risk.
How so?
If we connect this to the bigger picture, the distinction really lies in the difference between creating value and consumption.
Right. The difference between buying a cash-flowing duplex and buying a depreciating asset like, I don't know, a boat.
Exactly. Using equity to acquire appreciating assets or boost income potential accelerates wealth. But using it for short-term consumption does the exact opposite, and it goes deeper than just avoiding luxury purchases.
Okay, what do you mean?
It comes down to the debt service coverage ratio, or DSCR.
Ah, the math.
Always the math. If you draw $100,000 from a HELOC, that creates a new monthly debt obligation.
Right.
Now, if you use that $100,000 to put a down payment on an investment property, that new property must generate enough rental income to cover its own mortgage, its taxes, maintenance.
And the 8 ELC payment.
Exactly. And the new monthly payment on your HELOC. If the income exceeds the total debt service, you have effectively created a self-sustaining wealth engine.
You used debt equity to acquire an asset that pays for itself.
Yes. But if the rental income falls short, you are subsidizing an investment property with the income from your day job.
Which is painful.
And simultaneously putting your primary residence at risk. That is the danger of leverage.
Yeah.
Accessing equity accelerates velocity. If you deploy it into cash-flowing assets, it accelerates wealth creation. If you deploy it into negative yield assets, it accelerates financial ruin.
So the math has to be ruthlessly objective.
Ruthless. And there's also a hard mathematical limit to borrowing, right? You can only draw so much equity before your debt-to-income ratio becomes toxic.
Or the monthly carrying costs just suffocate your personal cash flow.
Right.
Most lenders won't let you tap past 80 or 90% of the home's value anyway.
Right.
So when you hit that borrowing ceiling, or when the physical asset itself is just holding back your portfolio's growth, you arrive at the third strategy.
The ejection seat. Convert it.
Convert it, meaning full liquidation and redeployment. You sell the property entirely to unlock the equity.
You just capture the entirety of the stored equity in one lump sum.
Right. It's like cashing out your chips at
Yeah.
one casino table so you can go play at several others.
That's a perfect analogy. The source lists options like moving to a new lifestyle or location, downsizing for cash, trading up to a higher value asset, or diversifying into multiple properties.
Like taking the equity from one highly appreciated coastal home and buying 3 rental properties in the Midwest outright.
Exactly. Think of it like pruning a massive overgrown tree. You are cutting down the giant concentrated trunk, your primary residence, and using those resources to plant a diversified orchard of smaller, more efficient saplings.
I love that. And there is a massive tax advantage to this strategy that makes it so potent. The United States, Section 121 of the tax code, allows a married couple to exclude up to $500,000 of capital gains on the sale of a primary residence,
Which is huge.
as long as they've lived in it for 2 of the last 5 years. You can harvest $500,000 of growth completely tax-free and inject it directly into a new investment.
Try doing that with stocks.
Right? You can't do that with stocks or commercial real estate without super complex 1031 exchanges.
The tax code basically subsidizes the convert it strategy, yet the source dives into the psychology here, and it's fascinating.
Wow.
In real estate, the biggest regret or the most devastating financial outcomes don't usually come from selling too early.
They come from waiting too long.
Yes, waiting until life forces the decision.
Because people get paralyzed by the idea of giving up a low interest rate, or they develop an emotional attachment to the house.
They hold on until a forced decision happens, and a forced decision is driven by external pressures. A sudden job relocation, a severe health issue, a divorce, or a massive spike in property taxes.
Things you can't control.
Right. When you wait until life forces your hand, you lose your negotiating leverage. You transition from a proactive seller choosing the optimal market window to a distressed seller who simply needs liquidity within 30 days.
You are selling from a place of pressure, not power.
And the buyers and the market will price your asset accordingly. Reactive decisions rarely produce the best outcomes.
This is the alternative.
The source poses this really proactive question. If you converted your equity today, what could that money be doing for you? Could it generate enough passive income to cover the rent on a much nicer home?
Or fully fund a business acquisition.
Exactly. If the redeployed capital offers a significantly higher return or better quality of life than the current house provides, the strategic move is to convert it proactively.
Now, up to this point, we have focused heavily on people who already own property, people who have already accumulated this equity.
Right.
But what if you are listening to this deep dive and you don't even own a home yet?
This is where it flips.
Yeah, the source material reveals how this exact framework is actually a superpower for prospective buyers. Understanding these 3 paths, leave it, access it, convert it, completely changes how you evaluate a property before you purchase it.
You aren't just buying a house, you are stepping into a long-term strategy.
Here's where it gets really interesting. Smart buyers look for very specific criteria. They look at location and appreciation potential, rental and income flexibility, future resale positioning, and equity growth opportunities.
They're basically stress testing the property before they buy it.
Exactly. If a buyer is evaluating a property for the leave it strategy, they aren't just looking at the current neighborhood, they are analyzing the path of progress.
Are commercial developers pulling permits nearby?
Right. They're looking for macroeconomic tailwinds. For the access it strategy, they look at the physical mechanics. Does the local zoning allow for an accessory dwelling unit, an ADU, in the backyard?
Or is there an unfinished basement with a separate entrance?
Yes. Properties with dormant potential. And for the converted strategy, they're evaluating market liquidity. Buying an ultra-modern home in a neighborhood of traditional colonials might be a great place to live, but it's going to be a nightmare to sell.
Because the buyer pool is so small.
Exactly. Smart buyers purchase properties that appeal to the widest possible demographic, like close to major transit hubs.
So that when it is time to convert the equity, multiple buyers are fighting for the asset. This raises an important question, and it reinforces the core theme of the text.
Which is?
Intentionality. Equity is something you must intentionally leverage, protect, or reposition. The absolute best decisions are made before you actually need to make them. Smart buyers separate themselves early by underwriting the exit before they even sign the initial closing documents.
That is such a powerful mindset shift. So, to briefly recap the 3 strategic paths we've covered today, you have leave it, letting market appreciation do the work, but recognizing the hyperlocal risk.
Right.
You have access it,
Yeah.
tapping into equity via debt instruments to create value, not defend consumption.
Crucial distinction.
And finally, convert it, capturing the equity tax-free and redeploying it proactively before life forces your hand.
Those are the 3 levers.
So we want to address you, the listener, directly. Remember that equity is not just a passive number that builds over time. It's a tool, and it's waiting for instructions.
It needs a job.
Take a hard look at your own living situation, whether you own right now or are planning to buy. have a conversation about what your next strategic move could look like.
I want to leave you with a final thought to mull over, building purely on the source's concept of conscious asset allocation.
Let's hear it.
The text points out that leaving your equity untouched is a conscious decision to tie your net worth to one asset in one location. Ask yourself this. If you had the exact cash value of your home's equity sitting in your bank account right now, completely liquid, would you actively choose to invest 100% of it into the very house you are sitting in? Or would you put it somewhere else?